Investors seem optimistic about the prospects of a Canada-U.S. trade talks carrying on after Canada rescinded the digital service tax, complying with what the American president demanded. Markets trading around record highs today. My next guest sees more bullish signals. Joining us now is David Dietze, Chief Investment Strategist at Dietze Wealth Management Group. David, thanks for joining us today.
Great to be with you today.
So we had record closes across the board for the TSX, the S&P, the NASDAQ. Are the markets just looking for real trade deals or just signals that talks are progressing?
Yeah, I really think it's the latter. We are coming up to a hard deadline, July 9th, but Treasury Secretary Bessent has suggested that those countries that are negotiating in good faith could well see those deadlines extended to give negotiators more time to work out the details. Those who are considered so-called recalcitrant may have the hammer brought down on them. But, we have seen, of course, since liberation, so-called Liberation Day, that if that ultimately affects the markets, we have seen this administration quickly backpedal to renegotiate things to give the markets reason for optimism. And that's why I think we've, come back so much from an intraday bear market on April 8th and all the way to brand new records here.
All right. And you believe the markets are headed even higher by the end of the year. What do you see happening here? What's driving that?
So first of all, inflation is staying pretty quiet here. Notwithstanding the fact that tariffs are higher than they were at the start of the year, we have not seen that really come through the general price level. We may yet see that, but so far so good. Further, of course, interest rates, which would be, you would think, the first signal that there's inflation out there, are really staying very quiet here. Indeed, today was a perfect example with the 10-year Treasury coming down 5 basis points, even though all signals in the market were a strong economy. And of course, we still have the backstop of the Federal Reserve. Right now, of course, they're talking hold the line. We don't have inflation back into the 2% bottle. But nevertheless, two members of the Federal Reserve are suggesting that they could even cut rates as soon as July. Certainly, the overall dot plot suggests we'll see 2 cuts by the end of the year. And the pressure is increasing on Chairman Powell to keep rates low and to cut rates. Now, of course, he's pushing back vigorously, and history supports that position. The last thing he wants to do is be the person that let inflation back out of the bottle. Nevertheless, he's winding down his term. He wants to deliver this economy in good shape by the end of the year. So at the end of the day, I think even his policies will tend to be dovish as we go into 2026.
Okay, so tell me what you're seeing in U.S. consumer demand.
So it did soften. There's no question about it in May. And so we are monitoring that quite carefully. But at the end of the day, what drives consumer demand, most importantly, is the job market. And we just are not seeing the weakness in the job market. Oh, yeah, here and there we see some notices on layoffs and so forth. Some of the tech companies have trimmed forces and so forth. But as a general proposition, people have jobs, wages are rising. And so I think that's ultimately going to provide a good backstop to consumer spending, which of course is about 70% of the overall economy. There is weakness in manufacturing. Of course, there's been weakness in manufacturing for like the last decade. This is a service-driven economy. So I think by and large, we're kind of happy with the way the economy is going.
Let's talk about your stock picks at this point. You like General Mills, but it sold its yogurt business. Was that a surprise to you?
So, what we like about General Mills is that, this is a company that's over 150 years old, is a category leader in all sorts of consumer staples, Haagen-Dazs, Cheerios, things like that. And of course, they have a record of paying dividends for about 146 years in a row. So what they have to do and what they are doing, because they're trading so cheaply, they're down, I think, about 40% over the last several years here, is that they are looking at the lower performing sectors and they're trading them. But what I like about what General Mills' strategy is, they take that money and provide more dividends to investors. They're also big on stock buybacks. So our calculations are you could get an 8% return yield between stock buybacks and dividends going forward. That's almost double what you get in the 10-year Treasury. And this, of course, is is a company that consistently increases earnings over time. If the market, if I'm wrong and we have some recessionary concerns come back into the market or some sort of volatility from unexpected trade war developments, General Mills is going to be the company you want. You got a 4.2% dividend, so basically get the same yield as a 10-year treasury, but it's going to grow over time.
Okay, I do want to get to your next pick. We've been watching a lot of the healthcare sector be either ignored or not really do much over the past while, but you like Pfizer, the pharma giant.
Yeah, so they're at rock bottom valuations for a giant pharmaceutical company. They're a blue chip, of course, in about 125 countries around the world, one of the best sales forces, one of the top pipelines. But now, because the stock is sold off to less than half of what it was at the height of the pandemic because of its development of COVID-19, you've got a stock yielding 7.1% with a PE that's under 10, and therefore the earnings well cover that dividend. So I think you've got a situation where they put all their resources into COVID-19, they knocked out of the park, that kind of emptied out their pipelines, so they're having to rebuild the pipeline. But when we see what they've done over the last 100 years, they trace their history back into the 1800s, we are very confident that they're going to release a lot of new products, particularly in the oncology area. They had a key acquisition of Seagen. And so I think you're going to see some positive news there. You got to 7.1% dividend. The other wild card, of course, is the Trump administration and other policymakers want to push down drug prices. But again, at the end of the day, they wanted to increase tariffs too. We see what's happened ultimately to support strong drug development, to support a healthy healthcare sector. You're going to have to relax some of those directives. Plus, of course, no one has done battle with people like the pharmaceutical lobbies. And so ultimately, I think some of those concerns will start to abate. And I think you're going to see better action in a blue chip like Pfizer.
Got it.